Hello and welcome to Fortrade. The topic of this video will be trading strategies with moving averages. First, we will outline how an investment plan should be the starting point of every investment. We will examine its components as factors that should be taken into consideration before opening a position. Then we will turn to the content of the presentation, moving averages. We will analyze types of moving averages and explain scalping, i.e. short-term trading using moving averages. Finally, we will present examples of how moving averages are used in combination with other indicators. Before trading, it's important to consider a few things in advance. Market sentiment. Personal position on risk. Are you risk averse or do you actually enjoy risk? And of course, it is very important to consider your personal financial situation. After that, you should decide which financial instrument you would like to trade. Stocks, bonds, investment funds, CFDs, etc. It's also important to have an idea about potential profits and losses, and possess some knowledge about indicators and trading signals. Having an alternative plan in case the current one isn't going well is important too. It may seem that this kind of preparation takes some of the fun out of trading, but if you are unprepared or have unrealistic expectations, you won't stand a good chance of success. Market sentiment is important in that it shows which positions investors hold, what their preferences are, what they are buying, and what they're selling. Market sentiment is the result of the collective assessment of current economic and financial conditions on the market, and the psychology of investors. In a way, it's the final indicator of all the factors that influence their decisions. Market sentiment has particular importance for daily traders, short-term investors, and those using technical analysis. The market sentiment indicator can be found on many specialized websites. We all have a different position on risk. Some of us like risk and enjoy the thrill of uncertainty, while others prefer a more conservative position and seek to avoid or minimize risk. It's important to define your stand on this. Investors are usually classified as short-term, more aggressive investors, or longer-term investors, which prefer lower risk. Both types of investor will interpret and use certain technical indicators in different ways. The leverage and lot size of the instrument we want to trade with will depend on the risk exposure of the position taken. Any chosen financial instrument has a preset leverage rate on trading platforms. Currency pairs usually have a 1 to 200 leverage, while crude oil has a 1 to 50 leverage. Conventional traders tend to choose financial instruments with a low leverage of 1 to 10, while more aggressive ones, so-called speculators, use leveraged products higher than 1 to 50. We can control a financial risk with a stop-loss order. The unwritten rule is that a stop-loss should be set around 2 to 3%, thus minimizing the loss. A more efficient way of controlling the risk is the lot size you trade with. The lot size is set when opening a position. It is a standardized trading unit that differs depending on the trading instrument. The larger the lot size, the greater the risk, but the potential profit is also higher. We should, above all, be very familiar with the financial instrument we want to trade with. The best choice would be instruments we have been following for a while, for which a sufficient amount of news and information has been received. You should not spread your attention on too many instruments. A good idea is to focus from 1 to 3 instruments at most, particularly if you are an inexperienced trader or have a limited time available. Correlation of the traded instrument with other instruments on the market is important too. For example, gold and the dollar have a negative correlation. Short-term CFD traders tend to choose less liquid instruments and those with higher volatility, where price oscillation is higher. They may also choose more exotic instruments such as the New Zealand dollar, Japanese yen, or Canadian dollar, Australian dollar, etc. Since these instruments are less traded, investors who enter these markets exercise a greater influence on the movement of the price. More common instruments are less volatile and more liquid. Thus, the oscillations are significantly smaller. I hope you found this video about trading strategies useful. Please join us again at Fortrade soon.